Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is What Affects Asset Rotation? So my name is Shen Chu. I'm the moderator for this webinar. So today we're going to learn what are the types of asset classes there are in the market and what affects the hot money flowing from one asset to another. So before we begin, let me just read to you the disclaimer. So whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now allow me to briefly introduce our speaker today. Now, she worked in the semiconductor industry for 17 years, with the last role being the automation APAC manager at Intel. So she began part-time trading in the Malaysian market in 1992 and in the US market in 1997, and before she became a full-time trader in 2008. She has extensive experience in stocks, options, CFD, forex, and futures, and her core approach is top-down from macro to industry and to stocks. She uses a combination of fundamental and technical analysis. She is very passionate in trading psychology, as she believes that money management and psychology contributes 90% of the success in achieving consistency in investment and trading. And she founded Beyond Insights in October 2008 and focusing on investment and trading education. So she's none other than the founder and chief trainer of Beyond Insights, Miss Kathlyn Toh. So Kathlyn, good evening. How are you today?
All right. So let's get started. The objective of this session is to get you to understand what is asset rotation and why is it so important to investors and traders. This is actually the big move. And that's why I believe that if you want to be very successful in investing and trading, this is an essential knowledge to have. Okay. The second part is, before I go into asset rotation, I need to start with asset class. Otherwise, you may not understand, right, what to rotate to, right? So asset rotation is the rotation between the assets. So first, you need to understand what are the various asset classes available for investment and trading in the financial market. Doesn't mean you will invest in all of them, but you know that sometimes the funds will move out of what you are investing, right? Like stock. When the funds move out of what you're investing, it will still affect the stock market. And once you understand the asset class, then I can talk more about what actually affect the asset rotation, which means what can trigger the funds move from one asset type to another asset type. And last but not least, I want to make it more practical so you can see an actual case study. And I see that most of the attendees in the Bursa webinar are stock investors or traders. So I relate to how it impacts stock investors and traders. And the most common asset rotation is between stocks and bonds, although there are other types of rotation. So I want to keep it simple here, between stocks and bonds first, and what actually trigger those. Okay. All right, let's start off with the first section, which is what is asset rotation and why do you need to understand it? Why is it so important to you as an investor or trader? Right. So asset rotation, let's go with the standard definition first. I will give some examples to make it more layman. Yeah. Asset rotation is the strategic reallocation of investment from one asset to another asset. So usually for retail traders, most people will not be so aware of it unless you're very experienced and you really take note and learn the macro level of investings, right? Like the tops-down approach from macro to the sector to the company level, which I will elaborate towards the end, okay? But for those big funds, right? Big funds manager, like for example, all the unit trust funds in Malaysia or big funds like the BlackRock in the world, right? And also the hedge funds manager. They actually put a lot of focus to understand how assets and funds are rotating. And when the major market sentiment change, it may trigger them to move funds in a big way from one asset class to another. So why do they want to do that? One of the main reasons is manage risk, right? So when the market condition is changing, when there are big risks, then they will need to reallocate their funds differently rather than to keep it in the stock market. Or sometimes it could be different economic cycles, right? From the growth time to the recession times, asset will move to different types of class, right? And there is two types of rotation Actually, there are more types, so to keep it simple, there is asset rotation between the classes. There's also sector rotation, right? So after I explain asset rotation, I can briefly talk about sector rotation because that deserves another topic altogether. Right. So these are the main reasons why asset rotate, right? Market condition change, economic cycle change, and also performance trend. Like sometimes certain asset class perform better, and the fund manager will want to relocate to make sure that they can perform better by reallocating to some of those asset classes. For example, for a long time, a lot of fund managers do not allocate to cryptocurrency, right? But because of the boom of the Bitcoin and so on, then some fund manager has already started to allocate a lot more, right, in the recent years. Okay, so that sometimes because of performance trends. Okay, so in a simple layman term, rotation means they are buying what is anticipating to go up and selling what is falling or anticipating to go down so that they can manage the risk and enhance their returns. So why is it that you need to understand this, right? Even though you're not a fund manager for the big funds, right? But it will still affect you because when all these funds are moving in to stock market or moving out of stock market, do you think it will impact you? What do you think? Yeah, just type on the chat. I like this to be a more interactive sessions, and like do you think it will impact you when the big funds from all these the fund managers, right, when they're moving around the funds, right, from stocks out of stocks or into stocks or move it out of the country, right? That will impact you as well. So it's very important for you to understand this. So one of the most important reason is it helps you to optimize your returns, right? So when there's a major economic shift, especially when there's an anticipated recession, right, then usually funds will move up. The other one is currency shift, right? Later on, I'll give you an examples. Previously, I have another talk about how currency impacts stock market. Okay, but towards the end, I have an example for you as well. For those of you who missed my earlier session, anyone here have attended my earlier sessions on currency impact to stock market? Yeah, if you have, okay, great. Okay, yeah. So right now, the asset rotation are more complex, right? They are not only within a country. Okay, so in the past, asset rotation maybe in Malaysia, especially will be just between stocks and bonds. So a lot of the unit trust fund in Malaysia, they have equity fund, which is based on stock, or they have bond funds, pure bond funds, which they consider to be the safer funds, right, for fixed income. And there's also something called balance fund, right? It's a combination of equity and bond. So when you buy a unit trust fund that's called a balance fund, the fund manager will move between these two, right? It could allocate higher on equity or lower on equity or higher or lower on bond, depending on the risk in the market. Right? So those of you who buy a bond fund, you may not know what they are doing, but that's why you buy it, right? So they will do all this for you. Okay. But in the global context, asset rotation is much more complex. Okay. With the example, it can explain better. And the major drivers for this rotation are usually based on global events, right? For example, the U.S. Federal Reserve or the Bank Negara having a policy shift. Okay. So one of the potential confusion that people may have is what is the difference with diversification? Diversification is different. Diversification is, let's say you are worried about the funds rotating from one to the other and you don't know when it will happen. So some people will have a diversified assets. So for example, you can have certain allocation to equities, certain allocation to bonds, certain allocation to cryptocurrency, certain amount to gold, right? Or some to agricultural fund, right? Or commodities, right? Commodity funds. Then it will be more balanced out. Okay, but this is more complex. Usually for big fund managers, they do that, right? Not for individuals. But if you are more sophisticated investor, then you may do that. So this is called a diversification strategy, right? This is not a particular optimization, because normally when you're balanced fund, you're not so optimized, right? It's just you are balancing between the risk and the reward, right? It's sort of settled somewhere in the middle. And sometimes it may not be exactly in the middle, right? It's quite tricky to really do it well, okay? Yeah, but what we are talking about by understanding asset rotation, once you understand it well, you can also tap into the flow, right? So when funds flow to this side, then you go to this side, right? Equities, right? When the funds move to something else, then you move your funds to something else. Only when you get more experience, okay? So let's move on. Let's introduce to asset classes first. So what are the type of asset class? Right. So there are these various types that are more common. First, the simplest one is cash, right? Cash has many forms, like our physical cash, which we seldom use these days, right? We use a lot of touch and go, grab pay, and so on. But how many of you still holding cash, right? Stand by a lot in your wallet. So I do hold some of the physical cash just in case. And we do have digital form of cash, which is in the bank, like savings account. But a lot of people don't realize, right? You also keep a lot of money in your digital wallet, okay, like your touch and go card. Yeah, those are a form of cash as well. And the companies that are holding this, they can actually make money from the interest rate. Yeah, you may not realize that. So just a little bit here and there. If everyone has like even 100 ringgit in there, you look at the whole Malaysia population, which has a touch and go card. Do you think that touch and go can make a lot of money from just the interest alone? What do you think? Yeah. What do you think? Do they think they make a lot of money from just the interest alone on the 100 ringgit in the touch and go card? Okay, yeah. And also the, of course, it's a short float, right? Yeah. So I won't go into that because that's part of the business model. So cash is one part of it. The second part is, so in the cash, what is the interest rate you get in the savings account? What's the interest rate you get by putting in the cash form, savings account? Just type on the chat. Yeah, it's barely. So most people don't know, right, how much is in the savings account. Too little to know. Very low. Huh? So probably 1%, 1% or less, right? So what about the next one, which is the fixed deposit, right? So which is the fixed income or cash equivalent. This is highly liquid. There's a few form here. One is fixed deposit, or the other one is money market funds. Money markets is actually a short-term loan fund. Later on, I will explain a bit more on that, right? Or the US government bonds, right? Yeah. Okay, so the fixed deposit, you can get about 3%. Sometimes you get some offer, which is about 4%. Yeah, that's about it. Whereas for the savings, it's only 1%. Then another instrument is fixed income for using bonds, right? Bonds, I'm not sure how many of you know what is bonds. Yeah? Just type on the chat if you know yes or no. If you understand what is bond, you type yes. If you don't understand bond, you type no. Yeah. Yeah, like all of you to be more responsive, right? This is a learning environment. Yeah, the more you're responsive, the more you can learn. Or too shy to say yes, no. It's quite common, people don't understand bond, but you may be buying a bond fund and still don't understand bond. Okay, let me put it in a very layman term for bond. Bond is essentially borrowing. Okay, example, let's say the government issue bond. Normally it's a very big amount, right? So example, let's say the government need money. So they will issue a 1 million ringgit bond. Yeah, 1 million ringgit bond. Normally they need more money than that. I just keep it simple. So when they issue a 1 million ringgit bond, normally individual will not buy, yeah, because the amount is too big. But the institution will buy. Example, let's say the public mutual fund, Khazanah fund, right? They will be buying this funds. So essentially, when they buy these funds, what they are doing is they lend the money to the government. So when government issue a $1 million bond, and let's say public mutual, right, bond fund manager decided to buy this 1 million bond, essentially public mutual is giving the government, right, 1 million ringgit as a loan. So in return, the government, right, with this bond contract is going to give a interest, which is called a coupon, right? So it's just like a fixed deposit, and there will be terms and conditions. Right? There are many, many types of bonds. So one example is half yearly, you will get a certain interest, right? It's called a coupon, right? Fixed returns. And at the end of the term, so the bonds can be as short as less than 3 months, right, to 6 months, 1 year, 2 years, 3 years, 5 years, 10 years, right? There's some 7 years, 20 years, or 30 years bond, right? Especially usually the government bond fund could be very long. So when you buy a 10-year bond, you will get back only your principal in 10 years. Okay, 10-year bonds means you lend to the government for 10 years, but every periodic terms, right? Periodic period, based on the terms and condition, you will get a particular coupon from the interest. Okay, yeah, but you won't get back your money until the end of the term. Right, so it's actually a debt instrument, although we still call it an asset class. To you, it's an asset because the money is yours, right? But to the government is a loan. So why would people want to buy a bond fund, right? The reason is typically is slightly better than the bank rate. Okay, it's not all the time and depend on the country as well. Like in the US right now, the bond fund are more popular, yeah, because the interest rate has gone up to like 5% earlier to 4.5% right now. So people want to maintain that if they are worried about any recessions, or they're worried about they wanted just some stable income. So these are usually attractive to retirement funds, right? Example, let's say the EPF, if they are happy with a 5% interest rate, right, they may buy a 5% interest rate bond fund, yeah, coupon rate bond fund, so that at the end of your retirement, right, you still can maintain you still can get back your money after factoring in inflation. Okay, so there are some fund managers who would prefer to do that. Yeah? Example, retirement funds, insurance funds, as well. And some of the unit trust funds that is based on bond, they may resell this to you in smaller units. So you can buy the fund is like 1,000 ringgit, right? Based on the contract terms. Okay. Yeah. So these are fixed income. So there is actually a rotation between stocks and bonds that is triggered by a lot of times based on interest rate. Okay. So that's what I want to cover. Bond itself is a big topic by itself because bond there are many types of bonds. Okay, later on I will show you some examples. And of course, stocks, a lot of you already know about it. Stocks are basically ownership in public listed companies. Okay, and commodities are raw materials that has a fluctuating price, and you can actually buy. This is not about buying and selling the direct commodities. Of course, you can buy and sell the gold, the physical gold bar, but it's about using futures trading, right, to trade commodities. And in the recent years, right, digital currency become more and more popular. For example, the Bitcoin, Ethereum, Solana, and so on, okay, or NFT. But these are higher risk instrument. It's another big topic by itself. There are more than 10,000 types of cryptocurrency coins, okay, yeah, and it's getting more and more. These haven't even considered what we call the meme coins, the most volatile ones. And the another asset type is real estate, which is the tangible properties. But there are a few ways to invest in real estate. Or the tangible assets, which includes the property itself or the land, and you can be directly buying it, right? Directly buying the property or the land, or you can do it indirectly via what I call the REITs, real estate investment trust, right? Which I will explain later. On top of that, there's also alternative investments, right? Which is one of it is called private equity. Private equity is a company that private example. Elon Musk bought over Twitter. Okay, so it become a private company. Okay, so they can still accept private investors, right? It's just you cannot buy and sell in the stock exchange. So there are quite a number of private equity funds where invest in companies like that. It doesn't go through stock exchange, but they can still invest as a shareholder. And there are also hedge funds. Hedge funds are there are funds that are managed in a slightly different way. Hedge funds means you can use many different type of instruments to protect. Example, when you buy stocks, right, there are many ways to protect. One is you have a stop loss when the overall market come down. The other way is you use hedging. You can have a long and short. You can be buying stocks and then you can short the overall index. So when the overall market come down, yeah, it will balance back. And you can use options. You can use futures, right, to hedge it. Okay, so those are called hedge funds. Hedge means protection. Yeah. So you can see there are actually many asset types. So you look at in the world, right, there's a lot of money, right? Yeah. So these are called the global money, right? Global money supply. So this global money will move to different asset types. So there are many ways they rotate. One is they need to look at which country first. Where would the funds move to? That is an even more advanced topic, right? Which is a global fund flows. Okay. I'm not sure whether how many will be ready to do that, in this webinar, because normally we don't have that many people as interested or ready for that level yet. Although we do have a course called Macro Insight which cover that. Yeah, so this is on the global fund flows, which is also very important. Yeah, because as you can see from Malaysia, right, in the 2014 when the funds move out of Malaysia in a big time, right? So if you understand that, you have you have protect your investment better, and then you will know when it's coming back, right? What is the conducive environment for it to come back. So that's the global fund flows. The second part is on this within the country, how the funds move between the different asset type, like here. right? Then the third part is within the stock, right? Let's say within those funds in the stock, how do they rotate between the sectors, right? From technology to finance, right? To the consumer staples, right? To utilities, right? How do they rotate, right? What triggers the rotation? So that's called sector rotation, right? Then there's also currency rotation. How does the fund move from one currency to another currency? Right? So you can see there are many types of rotation. So what we are focusing on today is actually asset rotation. And if you want to make the big money is when you need to understand the big money flow. Okay, big money flow is when you understand what really how the fund manager thinks, right? What triggers them to move the money from one to another. Okay. Right, so I keep it at this level first, so that can keep it more straightforward to people. Okay, so now let's look at the first asset type here, which is the fixed income. So I will do an overview of each one of this, but I won't want to spend too much time on explaining asset classes. So I hope you understand, because I want to explain the case study on what triggers asset rotation, which will be more important to you. Okay, so the next couple of slides, I will be giving you an overview of the various type of fixed income, right? Just treat it as an overview first, yeah? Since most of you will not be investing in this. So the first one is, what are the cash equivalent investment you can have? The most common one that most people are familiar with is fixed deposit. Okay, like those you can get from like Maybank, CIMB, or the different local banks. And it's time bound, you can go for the 3 months, 6 months, 1 year, and so on. Then there's also money market funds, which are not as popular to a lot of Malaysians because they're not so aware. It's a bit technical, but it is available. If you ask the bank, you can actually buy money market funds. So these are low risk funds, and the bank actually invests in like some short terms. Like it could be the short term treasury bills from the government. Okay, which they can get higher interest rate compared to the standard one. They can offer higher interest rate compared to the standard one. There are a lot of stockbroker account these days, which allow you can, they will ask you to apply whether you want the ability to swap between your trading account and the money market funds when you are not using the cash, right? You can either do it manually yourself, or you can have it as an automatic swap. Okay, so quite a number of companies are already doing this broker, so that you don't have your cash sitting there idle, because not all brokers give you interest rate on your cash. So this is where a lot of the newer brokers, especially, and some established broker, they start to help you to automatically move, to those funds and give you some interest, so they can use this to attract more clients as well. Okay, the next one is treasury bills. These are short-term government securities. So usually they term the government short-term securities or the bond fund as a secured bond, like secured instrument. So the interest rate is low because it is safer. Okay. However, when interest rate is high, like in the US right now, right, those short-term securities also fetch great interest rate. Okay, it's a good place to temporarily park the money, right, for the short-term securities. And there's also something outside of Malaysia. They don't use the word fixed deposit, right? They use the word the certificate of deposit. Yeah, they call it CD. So it's slightly different, but to keep it simple, you can treat it almost the same, right? It's issued by the bank. We don't use this term commonly. Okay? And last part is called the commercial paper. It's a short-term corporate debt, right? I won't want to go into too much detail there because most investors won't go into that. It's only among those big institutions they will trade this. So it's like short-term. Let's say company A needs some short-term money, right? So they will want to find who can give them this short-term loan, right? So then they can give it a higher rate because they need it urgently. Okay, so there's available short-term commercial debt, and the bank can actually help you with that. So normally all these are available to sophisticated investors, right? Normal investors are, normally don't go to this level. Like, but this is more of an awareness. There's more than what you thought is available for investing. Okay, so there's also a link here where I will share with you the just to give you some idea on what are the government securities out there. Okay, let me just click on this link first. Sorry for a while. The link launch on another of my website. Okay, just hold on. Just hold on. Just give me a minute. I think the link Somehow didn't launch. Okay, got it. Let's come back here. Right, so you can see, just to give you some idea on what are the government securities available and the interest rate. Right, so these are called MGS in short term. Malaysia government securities is actually a type of bond. So there are 3 years, 5 years, 7 years, and 10 years. And you can see the coupon rate. Coupon rate is the interest rate they will give to you, right? And also the you can see the government investment issues, right? So there are Islamic and non-Islamic versions of the bonds, right? And there's a different interest rate. So you can see the Islamic version are slightly higher than the usual one. So if you keep in this, you get a higher rate than your savings account. Yeah, savings account is, I think it's slightly about just 1%. Okay, and it could be slightly higher than the it depends on the fixed deposit rate at the time, so you can compare. Okay, yeah. So this is something that I think most people are not so aware of. All right, so let's go to the bigger understanding of the bond, right? Just now here is the treasury bills are very short term. Short term are usually around 3 months or less. Then there's also a longer term bond, and there are many types. Okay, I will go through this quickly because individual normally don't buy bond funds. You will go through like a unit trust fund, yeah, to buy. But what you need to understand bond is when a lot of fund flows are moving away from the stock market into bond. That means usually it's because of some uncertainty in the market. And if it's the other way around, is a good thing. Okay, so later on, I will share with you some examples. So what are the type of bonds that the funds can flow to? One is government bonds, usually the lowest one, lowest interest rate because they are considered more secure. Then corporate bonds, they are usually higher yields. Higher yields mean higher interest rate, but they are moderate risk, depending on what type of corporate bonds. And in the US, they have something called municipal bonds, which is issued by the local state government. Like US has many, many states. So each of the states, when they need money to develop the particular state, then they can issue their own bonds. Okay. Then in Malaysia, we have Sukuk, which is the Islamic bond, which is Sharia compliant. And there are also bond ETF. So for individual, since usually the bond contract is very big in millions of dollars. So individual, you cannot, it's not so accessible. Other than the municipal bond in the US, they have smaller denomination. Okay. So for Malaysia, people can buy the bond using the ETFs or through a unit trust fund. So in the US, there is the treasury bills that you can buy is the ticker, like 20-year bond is a TLT, and the 10-year bond is a IEF, right? That's the ETF. But do not buy them until you understand what can affect bond, yeah? Because that is quite technical. Yeah, you need to really understand the relationship between bond and interest rate, bond price and interest rate. Okay, and also asset rotation. Otherwise, don't buy. Okay, yeah. Then there's also something called convertible bond. So why are all these available, right? These are financing. So when companies or government need money, right, they need to have a way to borrow the money. So the way to it's just like stock, right? So the company can issue stock that people can buy. When you buy stocks, that means you are investing the money in the company. You are a shareholder. But sometimes the company doesn't want to dilute their shareholding. Like example, I say Elon Musk doesn't want to dilute Tesla so much, right? So he still want to have certain voting rights. So in that case, sometimes when the interest rate is low, they will issue bond. Issue bonds means you are actually lending. When you buy bonds that are issued by the company, that means you are lending money to the company. So the company pay you interest rate, but you don't have voting rights. Okay, that's the reason why you have corporate bonds. Okay, they don't want to dilute the shareholdings. There are sometimes more sophisticated bonds, which is you can convert your bond later to be equity, right? So there are certain terms there that say after X years, you can choose to convert to a stock. Okay, those are called convertible bond. So depend on how complex it is, right? You need to read the terms, right? That is only if you're really a more sophisticated investor, you read those terms and see whether it's in your favor. Okay, right? So now you get a bit of more flavor about bonds, right? All right, so let's turn to the next one, which is something you're more familiar, which is equities. In the US, they call it stocks. In Malaysia, we call it shares. So the most common one that you trade in the stock market via the exchange is called common stocks, right? Where you own the shares in a public listed company. But there's also something called preferred stock. okay, which is you get priority to the dividend first before the common shareholder get it, but you have limited voting rights. So normally in Malaysia, you won't get to buy this in the stock market. But if you're private equity, you want to invest direct in the company, like Warren Buffett, right? So you want to buy into certain companies, he can negotiate for, I want preference shares. Okay, that's how he bailed out, okay, some of the financial companies during the US financial crisis. Okay. So they are in the Malaysian market. I'm not so familiar with the preference share. Maybe that's available. So I need you all to let me know as well. Bursa for preference share got a suffix. Oh, okay, great. Yeah. So I haven't bought preference shares in Malaysia. I've only bought the normal common shares. Okay. Then the REITs is the security. So REITs is actually you treat like a fund, right? A fund is a pool of money managed by a fund manager. The fund manager can choose to buy anything, right? So can equity, bond, or commodity or REITs. Okay, so of course there's some standard definition for the funds, right? So let's say it's a REITs, that means it's primary property related. So this fund manager can choose to invest in rental properties. So if that's the case, then you get capital gain, right? So the funds will grow in value if the property increase in price, and on top of that, it get rental. So when they receive rental, they can also issue you dividend. Right? That's called REITs. And equity ETF, instead of buying the actual stock itself, you can buy the the equity ETF, which is a basket of stock. So there are many to choose, right? Even in Malaysia, you have the many types of equity ETF, and as an international level, like in the, let's say China, you have the internet fund, which is KWEB, and also in the US, you have SPY, QQQ, right? And you have all the sector ETF. Okay, so that's a lot to go for. And some of the funds are actually tracking the indices, but there are also some sector related fund. And some are just the fund managers choose, whatever combination that they wanted to, right? For like growth funds, okay, or income-based funds, dividend-based funds. And last but not least, this is a bit technical. There's called ADR and GDR. This DR stands for depository receipts, right? Example, in the US, you have Alibaba and Baidu listed in the US, right? They are called ADR. They are not directly, their headquarters are not in the US. So there's a more sophisticated issuance for those kind of shares. Okay, you don't have to get that. To you, if you're not investing international shares in the local exchange, then you don't have to worry about this. But if you are, you need to understand the rights and the privileges and what are the risks associated with ADR. Okay, especially when it comes to currency exchange losses. Okay, yeah. So so this is just to give you an overview of the type of equities. Okay, like in Malaysia, you have the Sunbay REITs, right? Okay. All right. So the next one, commodities, there's a lot. So I won't go into this one in so much detail because today I want to focus on stocks versus bond movement. Okay, but just to give you a high level overview, the way to trade commodities in Malaysia is via futures. And for Malaysia, our more popular one is palm oil. Okay, palm oil trading. There's also you can also trade gold, right? Gold futures that are more popular among people. And there's also index future. Malaysia, you can trade the KLCI index futures. There's also futures options available. But at the international market, there are so many futures you can trade, like precious metal, energy, like crude oil, agriculture. There are many types of agriculture, industrial metals like copper, aluminium. Then there's livestock. Okay, that's commodities ETF. Okay, instead of the commodity futures, you can also invest in commodities ETF. For example, there are uranium ETF, there are platinum ETF, there are also let me see, steel. Okay, you can buy steel ETF. So there are many of them, but do not buy them unless you understand how commodity works. Okay, so you can see funds can move into many different type of asset classes. So usually, just to give you some overview, commodity are very affected by supply and demand. And to me, I don't like to invest in commodities, right? Because when a lot of people demand something, then more people will provide it. Example, plantation. Okay, so when more people wanted to drink coffee, right, then coffee will be shortage. At one time, the coffee price go up. After that, more and more countries wanted to plant coffee, right? They are planting more, then the coffee price will come down. It is not like the stock market when you invest in the great companies, and when the companies continue to make more money, then the value will go up. So commodity doesn't work that way. So it's a totally different animal compared to stock market. Don't assume that when you know how to trade stock market, you know how to trade commodities. Okay. And I seldom see a commodity futures traders that trade all and know all the asset class. They are usually very specialized in one or two asset class, and they understand the behavior of that commodity very well. Okay. Usually commodities go up during inflationary cycle, especially those that are being consumed. It consume, like for example, like copper, aluminium, right? When there's a lot of activities, then there'll be more consumption, like in the industrial or the livestock, right? For example, cocoa, coffee, right? Cotton and so on. Okay, so they go by the economic boom and bust, and they will decline during the recession. So when you trade commodity, you need to understand that, right? The economic cycle plus supply and demand. Okay. All right. So I have covered many asset class. So just to give you some idea here, although not the main topic, I was supposed to talk about asset rotation, but just to let you know, there are many, many ways to trade all these asset class as well. Right. So one of the most popular way that most people know is the direct investment, right? So when you want to invest in a company, you just buy the stock. But other than just buying the stocks, you can buy what we call the futures contract, okay? Agreement to buy or sell the asset at the future date. Usually you don't have this for individual stocks, but you have it for indices. Example, you can buy a KLCI index futures. Okay, if you anticipate KLCI index futures to end the year higher, then you can buy the futures contract right now. So by end, let's say you buy it when the KLCI is here, based on December expiry, by end of the year, if the index end up higher, you will make money. But why? Because index is not like a stock. You cannot buy the index direct, because index is just the number. Okay, what's the number of points, right? So index, you have to trade it based on how many points it goes up. So futures work in a way that X points go up, then like let's say half point, you make 50 ringgit, yeah, something like that. And depending on the commodity type and which country indices are you trading. Okay, on top of that, so that's for indices futures, right? The other part is options. You can use options to buy stocks. In Malaysia, it's not available, right? The Malaysia, we have warrants. I will explain warrants later. Okay. So in the US and many other countries that are more established, like Europe market, you have something called options. So let's say you want to buy NVIDIA shares. Instead of buying NVIDIA shares direct, where you need to pay full, which is very costly, you can buy the options for NVIDIA share. That means you can buy the right to buy NVIDIA shares later. So why would you want to do that? Is because it costs you less. All these derivatives here, the reason people use it is for a few reasons. But the primary reason, one of the reason, is because you take less money to trade the instrument, right? Different derivatives, the leverage is different. Okay, the percentage you need to pay. Let's say the asset is cost 100, right? So depending on which of this derivative you use, the percentage you need to pay is different, and the risk for different type of derivative is different, right? Options, I trade a lot of options, and options is the one that can help you protect the downside. There are many option strategy. There are option strategy where the most you risk is whatever you pay. You cannot risk more than that. So it helps protect you better than the stop loss. Okay, so these are one of the contract that you can use once you get more sophisticated. For example, once you understand how to trade the stock market, you have a proper methodology, right? Options is one of the next level that you can consider. Okay, then forward, I won't explain this much. These are more sophisticated. This is a forex futures contract. Swaps is also an agreement to exchange cash flow, and these are usually bank to bank. Okay, yeah, so you will need to understand that. Contract for difference in Malaysia is available as well, but it's only available for sophisticated investor, which is your net worth is a few million. Okay, otherwise it's not available for individuals. But for other countries like in the Europe region and also in the US market, but you need to use international brokers. You can trade contract for difference, where let's say the stock price is 100. You only need to pay 33% of the stock price to invest or trade the shares. Okay, so and you make the difference of the up and down of the share price. Okay, so I won't go into details on this, but this is also one way to trade the stock market and the indices. You can use CFD to trade stocks or indices, right? Same for options. You can use options to trade stocks or indices. And warrants is available in Malaysia, right? Warrants is a type of options, okay? Is in Malaysia, we call it call warrant. Call warrant means, let's say Sime Darby want to issue a warrant, right? You can call it a child share, okay? So this warrant give you the right to buy the actual share later. Okay, for example, let's say why reason people want to do that is cost you cheaper. Now you don't own there are two ways, like options is it give you the right to buy the shares later, but you don't own the shares yet. Okay, but you can still make money from the up and down of the options premium. Right, it's a bit sophisticated. Don't attempt to understand everything here. Just want to give you an overview. There are many types of instruments. Warrants is a bit different. It gives you the right to convert to the mother share later. That's one example, right? There are many types of warrants. So by putting a smaller amount right now, by putting the smaller amount, the most you risk is that amount. Okay, so why would you want to do that when you anticipate, the main mother share, I call it, like it's going to go up later. Okay, then only you do it. If it goes down, you will lose money also. Okay, but you have a limited risk on the amount that you will lose. And there's a difference between options and warrants, right? Warrants you can only exercise usually on expiry. Yeah, we call it the European style. In the US, is the American style is you can exercise anytime. Okay, so since today's topic is not about derivatives, okay, unless there's a lot of interest on derivatives, I can start a lot of topics. Derivatives is my passion as well. I trade a lot of options. And the other one is structured products. These are available by the banks for sophisticated investor. They can have many different types of contracts, okay, that they can sell to you. Okay, that example we call it it can be a structured warrant, or it can be a structured product where they combine a few scenario. If that happen, then you will make money. Like, otherwise, you may lose money. Okay, so I won't suggest that you go into that until you get more sophisticated. Okay, so what is the derivative? The derivative is a contract that it's not an asset. Okay, it derives its value from how the asset works. For example, let's say you buy warrants on stock A, right? So when the stock A goes up, then only the warrants of stock A will go up together. When the stock A come down, then the warrant for stock A will go down together. Same for CFD, same for options. Okay, so this to keep it simple. So when you're buying derivatives or you trade using derivatives, you need to understand that you need to pay interest because you're not paying the full amount. So you need to understand whether it's worth it based on what you are doing. Okay, it's very subjected to the interest rate change. Okay, and when you have high leverage, you have higher risk, right? So make sure you understand that, and you need the proper risk management. Okay, so that's the derivatives. So it shows you there's so many ways to trade the market by itself. Yeah, tons of ways. So now, let's say you're not interested to understand all that and you master one thing at a time, right? And you're more focused on stock investing right now. Okay, so I'm going to share with you what can affect the stock market. Okay, so this is the big picture of what can affect the asset rotation or fund flows. So these are called macro factor. Macro are the bigger picture. Right? The first one, the most important, is this one: monetary policy. So why is it so important? I think some of you may have experienced during the COVID-19 crisis. Remember, the US and Europe and Bank of Japan, Switzerland, Bank of England, European Central Bank, they all printed a lot of money. What is print money in layman terms is they introduce a lot of money supply to the market, right, to help the market to recover, or the economy. Yeah? They say the economy, but actually the stock market benefit the most. So when that happens, that's the biggest boom you can find in the equities market. And when you can understand this, do you agree that that's the big money flow? Okay, yeah. So that's why the big money is in the big move. And if you understand this big picture, don't you agree that you can make the most money? You don't even need to pick so much on the individual shares. Yeah. Or if you choose certain shares but you don't understand the big move, you can still lose money. Okay. So monetary policy. Example, especially on money supply, right? Whether there's more money or less money introduced to the economy. And the second one is interest rate, whether interest rate goes up or go down, right? The US interest rate affect the global stock market. Okay, and also Malaysia interest rate can also have some impact on the Malaysia economy as well. Okay. The next one is fiscal policy. This is the most interesting right now. I think any one of you can tell me the most popular, what is the most significant things that affect the stock market right now? The whole world. Yeah, just type on the chat. What affect the whole world right now? Yes, tariff, right? So this is under the international tax policy, right? And it's actually a subset of tax policy, but right, it's under fiscal policy, right? Usually fiscal policy relate to local taxation, and there's another international trade policy, right? So this is like a combination of both. Okay? And you can see how it affects the entire world, understand? And entire world economy, which means also affect the entire world stock market. So don't you think this is very important to understand how is it impacting? Yeah. Then the next one is economic cycle, right? Economic cycle, which is how in different cycle the asset will rotate differently. I will go a bit faster here. Geopolitical tension, we can see that during the 2022, right, when we have the war between Russia and Ukraine, then the oil price shot up a lot, and also the inflation went up significantly as well, right? During COVID-19, inflation also shot up due to the supply constraint as well. Yeah. So based on this, it can also affect the stock market, right? Then so these are the natural disaster, earnings growth as well. Earnings growth, if they depend on which country have the highest earnings growth for the stock market, money can flow there. Okay, so which country in the world has the most profitable industry, for example, or companies, right? That can also affect some money flows. All right, so I will keep it at this level first because I want to make sure that I have time to give you some case study. This one actually is a big topic by itself. I just want to give you some flavor. The one that is colored are the one that has the biggest impact, right? And the top one is monetary policy, fiscal policy, and economic cycle. Okay. All right. So let's come to the core of asset rotation. So what caused money to move from stocks to move inside of to move into stock and outside of stock? It depends on one major assessment called risk on or risk off. Right. Risk on means the people are willing to take risks right now. Okay, they are confident to take risks. Risk off means people are not willing to take risks, right? Whether it's the fund managers or the individual retail traders. So there's usually this terminal. So when there's a risk on means it's a time to take risk, then the money from bond market, money market, and cash, the fixed income instrument will move to stocks. Okay. But after cryptocurrency became more popular, right, some of the funds also moved to crypto, right? Crypto is considered a risk asset, right? Stock market is also classified as a risk asset. So when it's called risk on, means move to risk asset, which is the stock market, commodity market, and cryptocurrency market. Okay. Fixed income are the other way around, which is bonds, money market, and cash. Okay. So during economic growth period and inflationary cycle, commodities tends to go up, but it also depend on demand and supply balance. So funds can also move to different country, right? As I mentioned earlier, they can also move to different country, not just between like stocks and bonds, and they are based on relative stock market performance. Okay, so let's say if one, so these are international funds, right? Malaysia funds may not move up that much because there's some governance on the capital outflow as well. But if you're a global fund manager, you can, let's say you can invest in any country. Normally you will look at which country can give you the best return, isn't it? Right. So that is based on fund flows based on relative stock market performance and currency trends. The country that are, so how do you think the money will move to stronger when the currency is strengthening or weakening? The money move to currency that are strengthening or weakening? Type on the chat. I want to make sure that you're still awake. Okay. Did I lose a lot of you? Okay. All right. So yes, when it's strengthening, right? So when the currency is strengthening, usually funds will move there. Of course, it's a combination of factors, not just the currency alone. So as I mentioned, the currency, the relative stock performance, then currency, and the overall valuation, plus the political stability. Okay. There are other matters, but these are the core. So this is when there will be more funds moving into stocks. And when it's a risk off, it's just the other way around, right? From stocks, you will see not all the money will move from stock to money market, but you will see a significant flow, right? This is a money market is a temporary parking space during the economic downturn, waiting, or the stock market downturn, waiting to come back into the stock market, all right? So that's money market, because money market is liquid, right? Like fixed deposit or short-term debt instrument, right? Where you can turn back into cash easily and move back to the equities. And when it comes to bond are more fixed period, longer term, right? It's usually when there are longer uncertainty, not temporary uncertainty, right? What are temporary uncertainty? Temporary uncertainty is when Donald Trump announced the tariff, right? People still figuring out after the 90 days, is it going to be good or is it going to be bad? So they temporarily move the money into the the money market first, park there, right? So that they can come back fast if need to, right? But bonds is different. A bond they anticipate is a longer period of uncertainty. Example during the what do you call that? Economic recession, right? They think there's going to be a more major recession, then more money will park in bonds. At least they can get a coupon rate, okay? Or when interest rate is high, yeah, when the interest rate is high, the income that they get from bond, assuming that it can cover inflation, then they say, oh, why not park there as long as it can cover inflation? Okay? So the one important part to take note is when inflation is high, it will take a higher bond yield to cover the inflation. So let's say if there was one time the US inflation was 9%, right? So when the US inflation is 9%, even though you give a 5% bond fund, are you going to make money? You won't make money, right? You receive 5% interest, but the value of money drop. Okay, so you will take more higher interest rate in the bond to trigger the funds to flow there. Okay, so at that time, money are still not flowing into bond. Yeah, so people just stay in cash. Yeah, so that's what I mean here. And when interest rate is increasing, so this is a more sophisticated relationship between bond price and also interest rate that you need to understand if you are investing in bonds, right? If not, then you can ignore this for now. When interest rate goes up, bond price actually goes opposite. Okay, interest rate goes up, bond yield go up, but bond price comes down. Okay, so that's what you need to understand. If you want to go deeper into understand how interest rate affect bond, right? Because once you get to a more advanced level, you know, when you understand interest rate, then you understand a big part of how money flow. Interest rate direction, anticipated direction is most important, right? Now the US Federal Reserve anticipated move in the next September FOMC meeting, right, where they decide on interest rate, whether they will cut or no cut. Okay, will move the global stock market. Okay, this is a very, very big move. So because when interest rate move up, let's say move down, when interest rate move down, the bond yield will also drop. When bond yield drop, right, then it can also affect, oh, now bond yield has dropped. Should I keep my money in bond? Because the return are not as much compared to the stock market, right? Then the funds will move into stock market. Understand? Yeah. So, but if you are trading bond itself, right? So that is the understanding from a stock market perspective. But if you are trading bond itself, then you need to understand that, let's say you buy a bond fund, when interest rate goes up, your bond price will come down if you sell before maturity. Okay, so I keep it to here right now because that will be another big bond topic. Okay, all right. So let's give a summary on what triggers funds to move from stocks to bonds. The biggest driver, you can write this down, is central bank decision. Right, usually is the biggest move for global fund flows as well as between assets. Okay. So central bank, especially the US Federal Reserve, right, affect the global money supply and interest rate. And this affect the differential of the currency between US and other countries. And that's the reason why it can affect the whole world. And other countries also benchmark what the US is doing, right, even for Malaysia. Of course, Malaysia, Bank Negara will also look at the current economy environment, right, and what are the specific goals and policy that the government want to achieve, right? Yeah, so then they will determine the local interest rate, and that can affect, let's say when Malaysia government, Bank Negara increase interest rate, will it increase or lower the affordability of people here? Yeah, when Bank Negara increase interest rate, how will it affect Malaysia economy? Increase interest rate. Yeah, it will slow down the economy because the cost of borrowing is higher, right? Let's say you want to buy a house, you want to buy a car, it will cost you higher, right? So that's how interest rate can affect the economy and therefore the stock market. Understand? Yeah. So this is one of the major part to know how funds will flow. So how does it affect us, right? When assuming, let's say in September, right, there's a anticipated interest rate reduction. Donald Trump has been pressuring the US Federal Reserve chairman a lot. However, the US Federal Reserve, the committee, FOMC committee, it's called the FOMC committee, they will look at the inflation, employment, and so on to decide. There are many factors they look at to decide whether it's time to cut. So if they cut, what does it mean? The US interest rate will come down. That means it will activate the US economy. That's what Trump's wanted. Also decrease the US borrowing costs, but it also lower the US dollar currency. Okay, so there's a impact, but this doesn't mean that it's not good to invest in US. You should sell all your US stock. Right? That doesn't mean that, because it will benefit US company, because let's say there's a company in the US where 60% of their revenue derived from international, then it will be good for them because international currency goes up, right? So it depends on what type of company you are investing as well, right? But it will also benefit the Asia market or Asia currency. Okay, then that is where it could trigger some fund flows to the Asia market. Okay, so that's one thing, but you need to always validate with the chart. Yeah. And then the next one is when bond yield go up substantially above inflation rate, then especially when the uncertainty in the market, then more money may move to bond, right? Then you find that the stock market may not move much. Okay, and the one of the biggest shift usually happen when there's a fear of market correction, right? So people, oh yeah, that may be a market correction or they are fear of recession, then they just move to the bond fund first or the fixed income instrument, money market or bond funds. So these are a few scenarios: potential recessions, high market valuation, they're worried about sell off, or in the US there's a seasonal pattern like September, usually plus minus 1 month. That's usually the biggest dip of the year based on statistics, right? So those are the time where people may move some money to bond fund, or they anticipate the hawkish central bank more interest rate hike, or the more tighten of the more uncertainty on tariff or tax hike. Okay, so these are some of the examples, and yeah, so the top part is what you need to understand more. The last part is optional for you to understand, right? So unless you're investing in a bond fund, bond yields are based on expectations of the future inflation, the economic growth, the probably a default. Okay, people whether can, let's say corporate bond, whether they will pay up or don't pay up, right? So if they are higher risk, then higher yield, and also how long is the term. Okay, so even though I talk about stocks and bond rotation, I just want to make you understand I'm not here to encourage you to buy bonds. Okay, so you should take this from the perspective of, as a stock investor, what are the impact to you, right, when there's a rotation between stocks and bond. Okay, just for that purpose, not to encourage you to buy bond without understanding what affect bond. Bond is a big topic by itself. Okay, all right. So now I'll give you an example of the how big an impact by understanding the asset rotation. So since the Malaysia bond yield, we don't have it easily available to correlate with the KLCI. I see a higher correlation between for the KLCI versus the US dollar and MYR. Okay, so and this is also related to what trigger asset rotation. Example, when the US dollar was going up a lot, right? Going up a lot, it also increased the US bond yield, okay, in the US. And it increased the differential between US dollar versus the ringgit. So you can see here, it's very, very highly correlated. When US dollar strengthen against the ringgit, KLCI comes down, right? Can you see the big impact here? Right, this was the time where it comes down here. And After that, we have a pegging, right? This is Asian financial crisis, right? So there's a peg, then it's stabilized, right? Peg at 3.8. Then it start to unpack. When we start to unpack the ringgit strengthening against the US, then it recover. You see the correlation? Yeah. Then when the US dollar go back up again, then this one comes down, right? This is the US financial crisis when US strengthened. It's a bit counterintuitive, right? That's it can be explained, but not in this current short time that I have, right? So the other part is you just need to know that when ringgit weaken, right? Ringgit weaken is back for our Malaysia currency, okay? And the strongest correlation is the US dollar, right? So this is another part where when the US dollar weaken against the ringgit, then you can see we have a bullish market, right? We have a very bullish market here. Right, so yeah, I forgot I have a pop-up here which I can show you. This Asian financial crisis. Yeah, I started trading in 93, so I have experienced this 97. I understand how bad the whole situation was at the time. US financial crisis. Then you have the this is also a major one where the ringgit weakened significantly against the US dollar, right? US dollar strengthened a lot against global currency. And at the time, we have the 1 MDB issue, remember? So this is where it caused the market to come down, right? Then when the US dollar weakened, then this one go back up, okay? And after that, remember, we have a long period where US dollar went up. So Malaysia, KLCI came down. So do you agree that it's very important to understand the US interest rate impact to Malaysia? And also US interest rate affect the US dollar versus ringgit. And US dollar versus ringgit direction, not the number itself, the direction and anticipated direction actually affect significantly the Malaysia stock market. So do you agree that it's very important to understand that? Yeah. Okay. All right. So this is what affect the asset rotation. Like, so this also affect funds, not just the Malaysia funds. So if you're a fund manager in Malaysia and you understand this and you're a balanced fund, you would have moved money from the Malaysia stock market to the bond fund. Like if you're not allowed to move international, like you will move to bond fund or the money market fund to temporary park there so that at least you can get some interest rate instead of losing money. Understand? Yeah. Okay, but if you are global investor, you have a few choices on different countries, you can have a balance. So right now, what can you do, right? If you are very new to stock market, like get good at what you're doing first, okay? But if you are more seasoned, like some of you are intermediate advanced, this is what you need to understand more, how you allocate between global versus the local stock market. And now when the US dollar when the US start to cut interest rate, right, that will be beneficial to the Southeast Asia, right, or international market, then it can strengthen the local market. Then you need to have all your stock pick ready, right? It doesn't mean that you sell all your US stock because, in terms of AI, which country is the best right now, right, that are investable, right? Yeah, so you still have a lot of great companies in the US and you still have great companies in Malaysia that you can invest, but you need to be prepared. You need to know Malaysia are much more sensitive to the currency differential, right, compared to the US market. So if you want to invest in Malaysia market, understand the big picture affecting the whole Malaysia market first, right? Then select the best companies within the Malaysia market. And when the environment is conducive, the macro factor conducive, then you have the best stock on hand. When you know it's about to turn, right? The worst is really like US interest rate is not going to go up further, right? It's still going to be flat to down, right? So there's an inflection that we have right now, right? It's just about to turn, okay? All right, so I hope you learn on this. Right, that's the COVID-19 and also the US tariff here. Originally, the ringgit the KLCI supposed to recover, yeah, based on the US dollar weakening. However, because of the tariff, right, on Malaysia, then it couldn't take off. Yeah, so we need to let that settle first. Okay, all right. So having said that, I just want to give you the big picture on this is how I approach the stock market with the big picture because I know the big money is in the big macro flow. So 40% of the overall on the stock price is affected by the overall market sentiment. Okay, 40% of stock price are affected by the macro factors, as I mentioned, especially central bank action, fiscal policy, economic cycle. Okay, that's the big one. And 30% are affected by the industry and sector trend. For example, now everyone talk about AI here, like, and fintech. So I just came back from ASEAN AI summit today. Okay, so there's so many talks about AI direction. So this is where the AI related stocks, right, the right one will have a boom for the for a longer cycle. And then from there, you choose the best company in those industry aligned with the mega trend. Okay, so this is where you get the biggest move. Does it make sense? If it makes sense to you, then type a yes. Okay, but as a beginner, right, if you don't understand all this, at least choose, you can do bottoms up, but make sure that you do the due diligence first. Okay, so just to recap, the big money is in the big trend. The big trend is in the big move, which is from the macro factors. Right, so make sure that if you're new, it's okay, right? Just start with fundamentals of the companies first. But once you understand that more, it's good to understand the macro factors. And this is what I experienced, especially for Malaysia. A lot of investors and traders focus too much at the company level analysis, and they overlook the big picture affecting the Malaysia market, and end up sometimes they get stuck like 2014 for a long period, like 4-5 years, like stuck in a sideways market. Like, how many of you have experienced that? Type of me if you have experienced that. Like, how you wish you have understand this earlier, right? Then you can relocate and then come back at the right time, right? Yeah, come back to the market at the right time. Okay, and that is very costly, right? If you don't know that, yeah. And success in trading does require a systematic approach, right? So if you don't have an approach, then it's good to have one. So let me just share with you how what is considered a comprehensive approach. Okay, in order to be consistent in trading, right? How many of you want to be consistent in your investing and trading? That means you can repeat the success, right? Not just short term you make some wins and sometimes you win, sometimes you don't win, you lose, right? Yeah, or you hope that it will come back type. Right? So in order to be consistent in trading, you need a complete framework, right? So I have one, it's called the SVS, right? Which we teach people. We are educated for 17 years already. So what is S? S means systematic. Right? Systematic means you need to have a clear process. For example, for investing, there's something called freedom model, right? From the big picture, how to shortlist the top stock in the market first. Like, let's say in US, there are 6,000 over stocks. In Malaysia, there are 1,000 over stocks. What is your process to shortlist the best one, the best fundamental? So you need to have a process, right? The second one is after you shortlist a handful of them, right? Then how to evaluate, right, whether these are good one, right? So that's the review, right? So we have a freedom model. Then once you shortlist the great fundamental company, then how do you buy? Right? What is the right time to buy? What is the right time to sell? And how many units can you buy? Right? So that you follow a risk management, right? No company is going to be ever foolproof to all conditions, right? So you need to have a systematic approach, and it's very learnable. So once you have a systematic approach, then it's not an afterthought. A lot of people buy stock, then only ask me, hey, I already stuck with this stock. What do I do? That's an afterthought. You should already have a process upfront. Okay, just follow the process, then it becomes very systematic. Yeah, the process can be easy to follow. So once you have a process, whether you are doing long-term investing, right? Trend trading, which is you keep for a few months, you just write the trend and you get out. Some stocks are more suitable for trend, not for long-term. Or you want to do range bound, right? It's called swing trading. Or you want to do intraday, right? You just trade 1-2 hours, then you sell off, okay? Like in a short while. Today I cannot do intraday trading, right? Usually I do it when when I can focus on it and there's a big move, right? Like yesterday is a CPI announcement. Those are big move, okay? Yeah, so this is where you need to know, no matter what trading style you are, long-term investing, mid-term trend trading, short-term swing trading or intraday, each one of them has a clear entry and exit. You don't mix them. You don't suddenly the short term don't work or leave it for investment. Okay, you need a clear approach to investment and trading. The second one is called versatile. What is versatile? You need to be flexible. When the things don't work out, you don't keep to that area. Right? Certain periods of the market are not conducive for doing, not suitable for keeping overnight. Yeah, example, it's still very choppy, still not stable. Those are better days for if you do intraday trading. Okay, so this is where you can be flexible, where you don't stick to one. You can have a standby. So let's say long-term investing, the deals doesn't come all the time. right? So you can have some short-term methodology and long-term, right? That's called flexibility. Or you can use different instruments to protect, like options, right? Depend on your experience level. And safe is the most important, okay? So you need to protect with money management. I always have a money management in place. Either I use a stop loss or I use a options hedging methodology, right, for my portfolio. Okay? And you need to have a maximum risk defined for every trade and a maximum risk for your entire portfolio. That's how you can have a peace of mind. And last but not least, this is what I realized from teaching 7,000 over students for the last 17 years. No matter what I teach doesn't mean everyone will follow exactly, because sometimes people just want to do their own way and they want to take bigger risks. So to me, psychology is still the most important, right? So you need to still manage your psychology. Okay, so if you have a systematic approach on how to screen stock, when to get in, when to get out, right? And also you have a flexible approach when it comes to market changing, right? Or you can stick to one style, it is fine, but you need to detect that there's a market sentiment change, not suitable for your style, right? Then stay out. And you need to make sure that you have a safe methodology and you follow your process, right? The psychology is to follow your process, then you can be consistent. Okay? Yeah, so I hope all of you can have this. Let me do a poll here to see, just to get a feel on how many of you have this approach. It's a good assessment for yourself, right? It's anonymous on this poll, right? So you just, it's just for you to get, for us to get a gauge how many % of the people in the market, right, has a systematic approach. Okay, and we do have an overview to help you to become more systematic, right? So if you're interested, you can contact us. Okay. All right. So any questions so far? Yeah, so sorry, I have too many slides and I run out of time. Any questions that I can pick from here? Shane, is there
Yes,
any questions that
fantastic.
I...
Yes, there have been many questions on the
Oh,
Q&A
okay.
panel already.
Okay.
So while the poll is being launched right now, if you have
Yeah.
any question to ask our speaker today, you may write
Uh,
your questions at the Q&A box. All right, we will do
okay.
our best to address as many
Okay,
of
I
them
saw
as
4
possible.
questions right now. Yeah, just
All
now I
right.
couldn't focus. Yeah.
So let's do the first question. Is P2P lending equivalent to private equity?
Peer-to-peer lending. No, it's not. Private equity is, example, a company is not listed yet. Okay, like Stripe. Stripe is a good fintech company. It's not listed yet. And you invest in those company. Yeah, become a shareholder of the company. That's a private equity. Yeah, peer-to-peer lending is different. Okay. Yeah,
Yeah,
peer-to-peer
P2P
lending
is
is
more
you can
like
lend
a
to your friend, just that there's a system that take care of that. It's a fintech ecosystem that allow you to, let's say they provide an application, right, or environment where you need money, someone willing to lend to you, you pay the interest, right? They provide a system for that. It is different from private equity. Yeah.
private
Okay.
equity is considered equity asset lah.
Yeah,
P2P
it's
is more
still
like
considered
debt.
a share. This
Yeah.
is not a share. Yeah.
Yeah, P2P is
Yeah.
more like debt as a class. You lend to SME, to get some financing rate, like in terms of interest.
Yeah.
So the next question is by Liu. Uh, why did the
Right.
foreign funds move out from Malaysia, even though the valuation of our
Mhm.
KLCI is very attractive right now?
Okay, interesting, right? So this is about global fund flows, right? I want you to put yourself. Normally, when I teach students, I like to I don't like to spoon feed. I like to get you to think so that it can be more lasting. If you're a fund manager, you're a global fund manager, right? No, not local fund manager. How would you decide, right, to put your funds, right? You would look at the uh okay, you can type on the chat first, right? Like as Malaysian, right? There's a loyalty, right? And we are here. Sometimes people feel that, oh, Malaysia stock market more closer to us. But if you're international fund, you will think very differently. Okay, you look at there are so many countries to choose from. I would choose that which country is likely going to excel. Understand? And which country has a lot of great companies for me to invest, because we are talking about stock market. Stock market means I want to look for attractive companies. And one of the big lessons I learned, I'd like to share with you is don't go cheap. Write this down. Okay. You may not agree with me, it's fine. Just write this down. Don't choose a stock just because it's cheap. There's always a reason why it's so cheap. Okay? That means nobody wants it. I'm not talking about Malaysia share, nobody wants it. but I'm talking about specific share, right? If you talk about, let's say, Top Glove, Harta Lega, why so cheap still nobody want? There must be a reason, because the company is already losing money, and what else? They're already not competitive in terms of the growth price compared to China, right? Let's say put the tariff aside, yeah, right now, there's a potential benefit of differential on tariffs depending on what Donald Trump decide finally on China tariff, okay? Yeah, so when you talk about pricing, how do we compete with China? So because of that, the company don't have a competitive mode. So even though it's very cheap, do you still want to buy it? Yes or no? Do you still want to buy companies like Top Glove or Harta Lega? Nothing, right? The company can turn around, so things can change later. As of now, what I mean is, do you think there's competitive reasons to buy even though it's perceived cheap? It's only perceived cheap, but it's like considered expensive if they don't have a turnaround story. Okay? Let's look at Intel. Why Intel is cheaper than AMD and Nvidia? Understand or which one is growing faster? Right? Nvidia profit margin is bigger. AMD is catching up with Nvidia. Intel is losing behind in AI. That's why it's cheaper. So do you want to buy the cheaper one, or you want to buy the better one, the greater company? Understand? Yeah. So that's one big mistake that I see a lot of Malaysians investor are falling into. They go for cheap PE. So you know where to find great stock? I'm a growth investor. Great companies are seldom cheap. And even though they are expensive, they go higher and higher and higher. How many of you have observed that already? Type on me if you observe. Great companies, right? You can see they are seldom cheap because people want them, right? The iPhone, is it cheap? Not cheap. Yeah. Yeah.
All right.
So remember, this is a big lessons that I fall into. Okay. So I hope that helps you. So the funds are not moving to Malaysia yet. First of all, part of it is tariff. The other one is they're looking at easy funds moving in and out, right? So they have many countries to choose from. Okay. And because of all this tariff cause more uncertainty, and the US dollar was still what they call it, strong at that time. Okay, so it hasn't really weakened a lot. Okay, so it doesn't cause a lot of fund flows. And AI is actually holding on a lot of the funds in the US because people want to invest in AI companies like Amazon, Microsoft, and all this. And this is not an advocate to buy these stocks. You need to understand the how to do it properly for different countries. Yeah. So there are still great companies over here. You need to find the one. Don't find the company in Malaysia just because it's cheap. Find the quality one. Normally they are more expensive, which is fine. They are more expensive. You don't have to buy at that time, right? Just find them, and then when the market pull back due to other reasons, macro reasons, temporary, that's when you want to buy. Okay, not because the company have problem. Like don't buy the stocks cheap because the company have problems. Unless you really understand the industry, you know it's just temporary problem. Okay, so I hope I answered that. What's the
All right.
difference between
Yeah.
ETF and index fund? Sorry, did I miss something?
No, no, no. The next question is about what's the difference between ETF fund and an index fund?
Oh, okay. Index fund, both are actually funds, right? Just treat it as a fund manager, right? They collect money from the public, and so they can buy something. But index fund must buy something that is part of the index. For example, let's say KLCI index fund, right? Then you have to buy whatever in the KLCI 30 composition. So you have to buy that. You cannot buy something else, okay? Yeah, that is not in the index. Let's say QQQ in the US, it has to model the NASDAQ 100. Okay, so let's say assuming now I cannot remember the percentage. Assuming it says Microsoft is X percentage. Assuming 10%. If Microsoft is 10% in the Nasdaq 100, then the QQQ must buy 10% of the funds. 10% of the funds must be Microsoft. Okay, so it must model that composition, the percentage. Yeah? Whereas ETF is general. It doesn't have to follow an index. Okay, you can buy. You can call a growth fund. Growth fund, you just buy growth stocks. Yeah. Yeah. Okay. Then the last
All
question
right.
here,
The next last question is
cryptocurrency.
from
Yeah.
Steve
Okay.
about cryptocurrency like Bitcoin and Ethereum are very popular nowadays. So quite a number of countries like America has approved them, right? So can you share your view?
Kindly share on what perspective? Quite
I
broad.
think
Kindly
what
share.
I think what he means
Cryptocurrency
is,
is a big topic by itself.
maybe you talk about how crypto can become mainstream, right?
Okay,
What
so
is your view?
one of the biggest move in the recent years on the cryptocurrency is because of ETF approval. That's actually affecting the fund flows, right? It's where money flows. So once it's approved, it just look at the biggest fund in the world is BlackRock. Okay, so BlackRock is you treat it like a very big unit trust fund. Right? In Malaysia, we have like Khazanah, we have a Public Mutual, we have Hong Leong Growth Funds, and so on, right? So, and BlackRock is the biggest ETF issuer in the world. Okay, so when they start, when the US government approved that you can have cryptocurrency fund, and these companies, especially Bitcoin, start first, means these funds they want to make money. Whenever there's people interested to buy, right, they can make money. They will issue a fund like that as long as it's authorized. So when they issue this fund, then a lot of these funds are billions of dollars, if not trillions, right? Billions of dollars. So once you have this billion of dollars and the people invest in this fund, they will have to buy the Bitcoin, and that's why Bitcoin will go up. Yeah, but right now it's not going as much because you have to look at when the addition comes in. Right? During the initial issuance is when it's more bullish. When people anticipate it will be approved, and when more and more funds are being approved, because not only BlackRock, there are many of the funds there. Right? Initially they approved eight ETF, and now we have Ethereum. Right? Solana is not approved yet. Right, they also applying for the multi cryptocurrency fund. Okay, so those are not approved yet. But when those are approved, then you will see, right, the money that in the fund is a crypto fund, so you have to buy cryptocurrency. But you need to understand the what affecting the cryptocurrency. Like regulation is one big part of it, right? So one of it is helped by Donald Trump. Right? Donald Trump is for crypto. He changed the we did actually a market update in our company on this, a big update on that, which is he actually changed the Security Commission chair. Okay, that is pro crypto. That is one of the big move as well. Okay, other than that, ETF approval, right? ETF for crypto. Okay, so these are one. Then the other one, the stable coin issuance. Recently, he approved, US approved what we call the Genius Act. Yeah, was also supportive of the what we call a stable coin. So I won't have time to explain the whole concept. Right, but I'm not here to encourage all of you to go for cryptocurrency, because cryptocurrency is an asset where you cannot evaluate the fundamentals. Okay, yeah, so it's based on what people are willing to pay. So it's a totally different animal. Right, so I invest in the crypto using hedging with options, right? So I can have a peace of mind. Okay, yeah.
All
All
right.
right.
So
So yeah, so I hope I answered most of the questions here, and I hope so. Is this beneficial to all of you? I hope I don't have too many of you lost in this. Yeah, hope you understand this is actually supposed to be an advanced topic. Yeah. And how many of you are interested in topics like this? You know, or let us know. Let us know what are the topics that you would like to know more. In fact, this is my last session for this year, and we still have Kut, which is our from our team, right? We'll be sharing one more topic. Yeah. That is coming soon, right, Shane? I can't remember the actual date. Yeah.
yes. All right. So look for having code again. Okay. So
Yes.
yep. So looks like that's all the time we have for the
Mhm.
session with Kathlyn today. So thank you
Mhm.
so much, Kathlyn, for sharing with us about what affects asset rotation. All right. So ladies and gentlemen, you just listened to the chief trainer and founder of Beyond Insights. Thank you so much, Kathlyn.
Okay. Thank you. All right.